Okay, so we're starting again. Welcome everybody to class. I'd like to introduce Jim Woods, a good friend of mine. We've known each other now for quite a few years. Jim has spoken here at Cal State LA to my classes previously, and Jim is a great newsletter writer and investor. So I'm just going to turn it over to you to tell you a little bit about yourself and your services that your newsletter services and things. So Jim, it's all yours.
All right, thank you, Dr. Wendy. Appreciate it. You guys like this guy as a teacher, right? He's good. Yeah. See, if you weren't a good teacher, I don't know if I'd be here.
They wouldn't be here.
I don't like to work with anyone I don't like, so. Which makes it actually kind of easy. You pick the right people to work with in the world. And that actually makes a big difference, you know. Worst thing you could have is a horrible job, a horrible boss or something that's really bad. That can actually mess your life up worse than the actual job itself. So if you ever find yourself, you guys are just starting out your careers and stuff, always try to get a situation that's compatible with you. You know? Because if you don't, it's like a bad girlfriend or bad boyfriend, you know. Eventually it's gonna make your life bad. So keep that in mind. I'm full of these kind of, you know, pearls of wisdom, as you know, right?
I do.
So, because you know why? I'll tell you why. So, I mean, we can talk to you about like metrics and PE ratios and oscillators and all that stuff. And that's all stuff that you need to know and that, you know, that you will find useful if you become, just even in your own investing, but especially if you become a professional and get an MBA or whatever, you're in this industry, or you teach. Obviously, you gotta have that information. But all that information is in the service of your life. Okay? It all should be in the service of a happy life. You know? Because what else is there? You know, you got one life. You got one life to try to make happy. So why not make it happy? And the best way, one of the best ways to do that, to assist you in getting yourself a happier life, is to have a lot more money than you think you need. Because here's the thing, money equals freedom. Okay? You want to be able to say F you to your boss or to your friends or whatever that, you know, or not your friends, but I mean, unless they're asking you for a lot of money. But if you want to be able to say, I want to do whatever the hell I want, which is the F you money thing, that's what you want, okay? You don't want to be in a position where you have to do what someone else wants you to do with your life. And you want to be able to do what you want to do with your life, okay? And there's no better way to do that than to have a lot of cash, you know, have a lot of net worth, have the ability to say, hey, you know what? I'm not going to do that today. I'm going to do just today, okay? But of course, unless you're born with it, which I don't think any of us are, I wasn't. Unless you're born with a lot of cash, you gotta earn it. You gotta make it happen for yourself. The only way to do that is to think, okay? Think and take action, okay? Make good decisions. Don't make stupid decisions. Don't go buy something you can't afford, get in debt. Don't go having like a bunch of kids before you're ready to properly take care of them. You know, stay married if you're married. If you're not married, stay non-married.
So true.
That's advice from experience. No, I'm just kidding, but I'm sort of not kidding either. You know, wait. You know, wait. Don't rush into things in your life. Make good decisions. You know, make decisions that are based on your best interest, not based on someone else's best interest. Because a lot of times we get in this trap where we say, okay, you know, I like this person, I like this situation, my family, you know, everyone expects me to do X, Y, and Z, and then you do it, but you're doing what they want you to do. Okay? You're not doing what you want to do. So the quicker you decide what you want to do, the better you are. Okay? That's why I asked at the beginning, who invests? Because one way to make your own decisions and do it is the earlier you start, the more you can build up, okay? And the more you can build up, there's no substitute for time, by the way. You know, you said you got a high yield account, right? If you leave that alone, don't touch it for 5 years, you can have a lot more money in there, right? If you add to it, you have even more money. Then if you buy like the right kind of stocks that way outpace that yield, you're gonna be even better, right? So that's the kind of thinking you wanna have on it, you know? You wanna have that longer term thinking. So, like Professor Wendy said, my main thing in life is I write newsletters teaching people how to do this stuff and showing them how to trade, showing them how to do long-term investing, showing them how we really pick stocks, not like how you're gonna see people on CNBC pick stocks. I mean, not that everyone on CNBC is not good. I mean, there are plenty of people that are, and I've been on there too, so I'm not bagging on it, but you know, you want to be able to do the things that aren't, you know, usually like what everyone says to do. Like most brokers, most people in the industry, I used to work for Morgan Stanley, you know, in the late 1990s, and I used to work at the World Trade Center. And when I got trained there by some of the smartest people in investment banking, but we always tell people, buy a diversified portfolio, hold it till the rest of your life, you know. And that's fine. I mean, that's good for like 401k money and IRA money and stuff like that, long-term money. You guys know all about long-term portfolio diversification, things like that. And they've covered that in the rest of the subjects and stuff, right? And those are all smart things. I'm not saying they're not. But it's not the only way to do it, and it's definitely not like the quicker way to do it. Okay. So today I'm going to talk to you about a service that I do aimed at high-end traders, because we sell the service for like a couple of $1,000s a year. And it's for self-directed investors who are looking to identify the best stocks at the right time, and who also use options to upsize their gains. I'm going to show you how I do it. It's not the only way to do it, of course, but it's one way I do it. I'll show you the results, and I'll tell you why I do it the way I do it. So this is one way of doing it, not the only way, but definitely a way that's worked for a lot of people. And it comes from a long lineage of really smart people that have been in the market for a long time. So I didn't make it all up as I went. Okay. What did I say at the beginning? Money equals freedom, okay? So I start off these talks with a quote from this book called Atlas Shrugged, which is my favorite novel. And have anybody ever heard of this writer named Ayn Rand? You guys heard of Ayn Rand? You should check it out. It's very good. It's beautiful. This book came out in the 50s, and it's still to this day, one of the best-selling novels. But her ideas were like very pro-freedom, pro-capitalism, pro-self-interest. And so like, well, this is me when I was a kid. My mom said, or this little cartoon here that I found says, I don't care about the drugs or the alcohol, just tell me who gave you these Ayn Rand books. Okay, so, subversive thought, right? All right, so here's the thing. If you ask me to name the proudest distinction of Americans, I would choose, because it contains all others, the fact that we're the people who created the phrase to make money. Okay? To make money. Americans were the first to understand that wealth has to be created. The words to make money hold the essence of human morality. Okay? So this is like a lot deeper level than just, what stocks are good for, the next couple of years. Okay? That's all the practical stuff. But when you're investing, okay, you're engaging in the essence of human morality. Okay? You're putting money to where you're using your mind to help create something that wasn't there before. Okay? Your freedom. Okay? Your ability to do what you want to do. And by investing in companies that are doing the same thing, creating a product, making a profit, delivering for shareholders, you're engaging in the concept of to make money. Okay? That's a unique American thing. You guys don't realize how special that is. Okay? People go, America's the greatest country in the world. So why? Why is it? Why is it, so doesn't some German guy think that about Germany? And some French guy think that about France? Yes, probably. But you gotta have objective knowledge of why it's the best country. And that's one of the reasons, that's why my argument is, we created the fact of how you make money. Because before it was like, in Europe, it was like, oh, well, you inherit the money, you got the king, you got the, the kind of hierarchy of royal families and things like that. We don't have that here. Just have people that earn. And you can pretty much do it. If you come up with a good idea, anything's possible. We all know that. Everyone says that and stuff, but it's true. And you don't even have to come up with a good idea to have a lot of money and have a lot of freedom. All you have to do is recognize other people's good ideas, okay, and piggyback on those, okay. My good idea is finding other people's good ideas, and that's how you want to look at it. Or you could think of something to do. Think of some kind of mousetrap. Go on Shark Tank or whatever. I'm friends with one of the producers there. People go, hey, can you get me on Shark Tank all the time? And they get like 50,000 applicants a year for that show, So it's not a joke, but it's true that that's what people do, and it's awesome. Okay. All right, so money equals freedom, investing for bullseye stock and options trades. So this is just some of the publications that I do. The one we're talking about today is called Bullseye Stock Trader. But I also have options only strategies called high velocity options, where I do straddles and puts and calls and different kinds of more sophisticated options trading. I also have a newsletter called Successful Investing. That thing's been around for 47 years. I was there before I was even around, basically, and I inherited it from a succession of like very smart people that have continued this thing for a long time now, and we've beaten the market like every year for 47 years. Pretty cool. I have this free e-letter called the Deep Woods. That you can just sign up for, and I recommend you do it because I talk about markets, but I also talk about politics, I talk about music, I talk about art, I talk about watches, anything that I'm interested in is cool, that I think is fun. I'll talk about it, and that's because, like I said, life's more than just, figuring out the PE ratio on the right companies to buy. So, have fun with it. Go to jimwoodsinvesting.com, and you get it all. You can get that free. And then I do a couple other things, a Fast Money Alert. I do that with Professor Mark Skousen, who's a friend of Professor Wendy and I's. He's a very well-known economist, teaches at Chapman University, written like 15 books. He and I do a newsletter together. And then I have a podcast too called Way of the Renaissance Man. So. All right. By the way, at any time, especially as we're digging into the details, you have questions or comment or anything like that, just let it out. Okay? I want this to be like more of a conversation than, just a dude lecturing. Okay? So, all right. So, I'm going to talk about 5 things that actually make the market, make a stock do well. These are 5 characteristics that I've found over like last few decades that not just myself, but other academics and other professional investors. We use these things to identify the best stocks. Okay. So, in this newsletter and in my investing approach, I always start with a mission statement. Okay. And you should do that too with anything that you do. Why am I doing this? Like, why are you doing something? Like a lot of times people will do something and they really won't focus on the why. They just kind of think it's, oh well, I'll just check it out and do it, whatever. But why are you doing X, Y, or Z? Like we talk about this with companies. You guys are all pretty much business majors or finance majors, right?
Finance.
Okay, so when a company starts, what's their unique selling proposition? Like, what are they doing? What's their mission, right? It's not just to like, oh, we wanna make a profit, but no, what do you want, how are you gonna do that? And it's not enough to say, oh, we wanna make the company successful, no. What is your mission, you know? Like, mission of that company, Lululemon, right? We all know that companies, they make cool fashions. And their mission was to create something that made people look better and that also allowed them to work out, and while looking better, you know? It was not, they weren't trying to play around with like, oh, it's just gonna feel good and fit well. No, they wanna look better. And it worked. And it's $1 billion, multi-billion-dollar company now, because people look cool when they're wearing it, you know? And that's the mission. So, in the Bullseye Stock Trader, which we also call BEST, as a little acronym, stock and options trading service that seeks out stocks outpacing the market. Okay, outpacing the market in several key areas. So that's a subtle phrasing, but it makes a big difference, okay? Because outpacing the market, what does that mean to you? What does that mean to you, like that term? Outpacing the market.
So it's like to me, it's like making that a step that it's gonna help you to pass the most of the people that are doing that kind of thing.
Yes, you're on the right track. So when I say outpacing the market, okay, I mean, I'm looking for stocks that are doing better than the rest of the stocks out there, okay? Now, I'm not just talking about price or earnings or sales or whatever, which we're gonna get into. But the point is, I'm not looking for some hidden company that has some potential big new invention that's gonna take shape in 20 years. I don't want that. I mean, I do want that. But I'm gonna wait till they're NVIDIA, not till they're like a tiny company that no one's heard of, okay? Because guess what? All the money's going into those companies. That's why they're outpacing the market, okay? So like, anybody like bet on or know people that, I don't do this, but does anybody bet or, you know, you guys know about horse racing, right? Okay, everyone knows what a horse race is. When you go on they always have the odds up there, okay? All these horses. But how do you know which one might be the best horse? Well, guess what? The one that has the longest odds, that's probably the slowest horse. Or something happened to that horse, right? The one with the tightest odds, the ones with the best odds to win, that's the ones that people are betting on. That's because when they're betting on it, they're not getting as much return, but they pretty much think it's gonna win. So think of the markets like that, especially when you're talking about stocks that are outpacing, okay? You want those really fast, good horses, okay? The key is knowing when to get off of it before they start to slow down. That's part of what we do too. Okay. All right, so how do we do this? So we start by identifying stocks that have what I call the big 5 major characteristics that tend to drive a stock higher, okay? All right, so here's your first big question. Who thinks they know what the number one reason why a stock moves higher? Yes, sir.
Inventor system, what is it, inventor system, like, their behaviors,
Investors' behavior?
yeah,
Like, what do you mean by that?
like,
You're on the right track, but
yeah, like how people will presume that the stock's gonna perform based on like certain news that comes up.
you're close. How do, when you say investor behavior, you talking about, what are you talking about exactly?
Like sentiment.
Sentiment, okay, yeah. But how do we measure sentiment?
Based on how they've been doing over the past like 3 months.
No, but how do we measure it though? What's the tool that we use to measure it? Yes, sir.
It's all about historical data or analysis.
What kind of data?
I mean, the previous past performances.
What kind of data though? You talking about corporate data like earnings and stuff like that?
Yes, I'm not
Okay.
going to.
You're partially right. You're partially right. Okay. Who else? Anybody else? You guys are around the edges on it. You're closer. Investor sentiment. How do you measure investor sentiment? Okay. How do you measure that? Yes, sir.
Volume.
Volume, like trading volume? What goes hand in hand with trading volume?
PE ratio.
What's the numerator on PE ratio? Price. Price, yes, price. Who said that, you? You get the gold star right there, sir. You guys were real close though. So, price, okay? Price movement. That's how we measure sentiment. That's what's reflected in the earnings. That's what's the numerator in the PE ratio. That's what determines the buying volume. So you all have it partially right. But the price is what matters, okay? Because you can have the best company that has really good product, whatever, really good, even good sales. If no one wants that stock, the price is gonna stay static, okay? Conversely, you can have a company with no earnings, maybe just a big promise of future results, but everyone's pouring into it, okay? That was like the early days of Tesla. They didn't have a car yet, but everyone thought it was a good idea, and they liked this crazy guy named Elon Musk. So people bought the stock. And now it's at like all-time highs again, you know. I'm glad I didn't sell it. So, that gets us to the first one that we just identified. Price. Now, what about price, okay? Is it just, is a stock that's $1,000 a share better than a stock that's $10 a share? No, right? Okay, well, why not though?
Buying power.
Buying power. I'm thinking of something else. Okay. So,
Potential.
what's that?
Potential.
Potential. Yeah, you're close on that. But here, think of it like this. Okay. The $10 versus $1,000, that is all that is a way to market. Okay. What if, yes.
Oh, I was gonna say, well, do you happen to look or consider, like what the company's actually worth? Like maybe you take into account that maybe the $1,000 stock might be overvalued, while maybe the 10 might have potential.
That's very good. Yes, we do take that into account. That's very good. But that goes to more of a fundamental analysis part of things, which we use. Everyone should use that, because you want to make sure you're not paying too much for a company. Right? That goes to the PE and PEG ratio, things like that, which you guys have learned about, right? Yeah, okay. But what I want to stress here on this part is, it's a relative price strength, okay? So the $1,000 stock might have been $1,000, or it might have been like $950 the previous year. It went up $50, well, that's a tiny little move, right? But that $10 stock might have started the year at $2, okay? That means it more than quadrupled, right? That's a big move, okay? And we want to measure, so which one's a better stock? The one that went up like 800% or the one that went up like 5%? Okay, the 800% one's the one you're really looking at, right? Because this, if you put $10,000 in the $1,000 stock, you have 5%. You put it in here, now you got like a lot of money. You're looking at like, 800 grand or whatever it is, depending on the math. So what you want to do is you want to measure the performance relative, okay, to the other stocks. So when I'm looking for stocks, I'm looking for the price. Okay, I'm measuring the price, and I'm screening out. What I'm doing is I take a database screen, and I'm looking for stocks that are doing better than their peers, meaning the rest of the market, for the past 6 to 12 months on a relative strength basis. So let's say the average stock is going up like 5%. So it's a normal kind of relative year, okay? Normal stocks going up about 5%, 10% maybe, okay? But then I have this other stock that went up 70%. Okay. That's the one I wanted to be in. And that's probably the one I want to be in again. Because why? Because the investor sentiment is pricing in growth. Okay? That's what you want. That's what I want when I'm looking for companies. Now, some people, and this is a totally valid way of doing it, they look at some stock that's had a big price move higher and they go, no, can't touch that. I don't want that because, hey, it's already made its move, right? But that's what they always say about every stock that's ever done really well. It's already made its move, okay? And I look at a stock and say, well, the stock was at $10 at one point, now it's at $100. How did it get there? Did it go from 10 to 100 in one day? No. It hit a new high at 11, and then at 12, and then at 13, and then at 15, and then at 20, and then at 25, and then at 30. It kept on going, hey, this stock's up a lot, right? But just because something's up a lot doesn't mean it can't keep going up higher, okay? It's because investors are pricing in positive metrics, okay, which we're gonna look at in a minute. But the point here with my style of investing is I want the proven winners that are outpacing 80% of all the stocks in the market, okay? I only want the top 20% of stocks, okay? There's about 6,000 stocks roughly in the overall market, the major markets. And there's a lot more than,
6 to 7,000.
yeah, 6 to 7, depending on, it used to be like 10,000. It's shrinking,
Yep.
Actually, the pool of investable stocks is shrinking, which is good for shareholders actually, because the more money is consolidating. And I think there's probably gonna be more of that with new administration allowing more favorable to mergers and things like that. By the way, here's my tip for the Trump administration as far as investing in it. Okay. Financials, the M&A kind of stocks. Big finance like BlackRock, companies like that, Goldman, JPM, and crypto. Okay. Crypto's not a stock, obviously. But who owns crypto in here? Okay, good. I think everyone should own a little bit of that, especially at your stage in life. Go out and spend $100 and own it right now. Own a little bit of it. Buy some like partial shares. I bet you I'd be willing to wager that would be up in 5 more years. It's going to be a lot more than $100. Now it could be worth 0 in 5 years. That's the problem with crypto, right? It could flux. You hear these stories of people that bought it like when it was like, whatever, 30,000, and then it went down to, or 40,000 went down to 20 or whatever, and then, or you hear people that bought it at 800 who still have it.
The stories I love to hear are the kind of funny are the ones that the people bought it when it was real cheap, and then they lost their password.
That happens.
That happens.
Yeah, they lost their key and they lost it all, yeah. No, I know, that happens, and, there's some weird stories around the whole crypto thing. Part of the reason why people like me and other people like Kevin O'Leary, my friend, you guys know who Kevin O'Leary is? Yeah, so he's a friend of mine. And Kevin is cool, and he told me that what we need in crypto is regulation. And he's not a regulation guy. I'm like, what are we talking about? And like, regulation? I never heard you argue for that, You're usually like the opposite of that, right? He's like, no, what we need is regulation, because then sovereign wealth funds can buy Bitcoin, and big banks can buy it. They can own it as a real asset because it's got some structural things. They can buy like through the ETFs and things like that. And lo and behold, like a year after he told me that, we have ETFs and stuff like that where we can own crypto. And guess what? All-time highs. big mystery, but he was right. And that's why he's a billionaire and I'm not. So okay. So the point here, of course, is this is the most important metric, is the price, the pricing in the sentiment, okay? And we only want the stocks that have the most positive relative price strength, okay? Because those are the ones that have proven themselves, okay? Because back to the horse race analogy, we only want thoroughbreds, no donkeys, okay? Okay, you don't wanna climb on the donkey when you wanna win the Kentucky Derby, right? Okay, here's the second point. Remember I said there's 5 key characteristics. Number 2 is earnings power. Now you got to this part a little bit with the analysis, what the fundamental, what's the company doing now? Do they have like a track record of making money? Yeah, that's the second most important thing, because the price is the most important thing, but what do people buy? They buy the companies that are killing it on earnings, right? They don't buy the companies that are losing money. You know, we buy the companies that are making money, that are returning value to shareholders, that are actually killing it in the market. Because to the victors go the earnings spoils. Okay. So here again, I'm taking like when I told you about the first screen, the price strength. So I look at that 6,000 or 7,000 stocks, and boom, all of a sudden I've got like 20% of those that are doing better than the rest. Okay. It's a pretty long list still though, right? But I have to whittle it down because I can't buy all those stocks. So then I'm looking for stocks that are outpacing, again, that word outpacing their peers for the past several quarters and the past several years in terms of earnings per share growth. Okay, growth. That's important because it goes back to those large numbers again. Like that $1,000 stock, they may make $1 billion every quarter. And that one company that's $10, they may only make a couple, 100 million in that quarter, right? But if they made 100 million this quarter and they made 20 million the previous quarter, they're growing their earnings fast. Whereas if that $1 billion a quarter company made like $1 billion the previous quarter and then $1 billion there, maybe like 999 million, they're not really growing. They're staying steady, they're making a lot of money, but they're not growing their earnings. And fast money, the money that we track here, the money that really makes a stock move higher, we're looking for the earnings growth, okay? That's what we want. We want the company to be 30-40% annual earnings growth rate for the last few years. Okay? That's actually one of the ways we measure earnings per share growth rate over the last few years and the last few quarters. So we want a company not just had a good quarter, but had a good last few quarters and a good last few years. That goes in this metric called earnings per share growth. Okay. This is where we would dig down into the numbers if you wanted to calculate it. We're not going to do that tonight, but I'll spare you the math on it. But know that the growth is the key, okay? Because Wall Street buys growth. Wall Street doesn't really like to buy value. They like growth. Individual investors that are buying dividend stocks, they like to buy slow and steady. But guess what? Slow and steady doesn't make you a multi-millionaire quick, It makes you, it's good if you're retired and got a lot of money, but this is how you get there, This is how you get to the point, or this style of investing, a more aggressive style, okay? So here again, we want the proven winners that are outpacing at least 80%. So I took the first 80% from the price, and now I took the second 80% or the second 20% from that group. Okay, so now I got a lot smaller, set to work with. Okay, because forget about like value investing. The real value is the earnings growth. Okay, that's what we like. All right, the third metric is technical analysis. Okay, have you guys gone over that? Technical analysis? None of that, right?
No.
So who knows
it for you?
Okay, that's cool, because that's my training. So, okay, who knows what technical analysis is? Yes, sir, back.
Finding the support and resistance.
Yes,
And
support
drawing
and
on
resistance, very good, excellent. Support and resistance are two components of technical analysis. There's two of our tools. Okay, so like if a stock is trading at 12 bucks, let's say, it's got support at 10. So if it falls down to 10, we know there's a lot of owners of that share at 10. That's called support. if the stock is at 14 and a lot of people sold it off at 14, and brushes up again, like 12, 13 is brushing up against 14, okay, maybe it won't break through that 14. You know, so that's the technical analysis part of it, so good job. Those are just two components, but very important components. So, beauty's in the pattern, okay? Once we've screened for the best of breed in terms of like relative price strength and the earnings power, then we need to check the technical pattern, okay? Because we want to determine if now is a good time to own that stock, or if it's a time to avoid that stock. Okay? Just as important, you want to know what to buy, but you also want to know what not to buy. Because these decisions really matter when you talk about real money, especially if you're doing it for millions of dollars worth of client portfolios. You know, they're not going to take kindly for, oh yeah, we lost like $2 million in your account today. Oh, really? Great. Well, why? Oh, we bought it at the wrong time. I mean, that's going to happen anyway, because there's no way to control that. If you're doing well in like 30 or 40% of the stocks you buy really well, you're doing really well. You got like a batting average, it's like baseball. Guy that hits 300, he's like a star. Okay? Guy that hits 200 is still in the majors, right? But the guy that's hitting, under 100, he's out. All right, so part of that support and resistance that you mentioned, okay, part of that factors into what we call the 3 bullish patterns. Okay, we want bullish. You guys know what bullish is. It means stocks are going higher. Right? Bearish means it's going down. So there's 3 basic patterns that I look for when I'm looking at a stock chart. First one's called a cup with handle. The second one's called I just call it a flat base. I'm just calling it a regular base. And then another one's called a double bottom. Okay, and these are all patterns that reflect bullish sentiment, or which means buying in the stock, or potential future buying in the stock. Okay? I'm going to show you a bunch of these charts in a minute, but the main thing is once you know that their stock is good on a relative price strength basis, and then also on an earnings per share basis, then you start to overlay some of these charts, see what they look like. Because some charts like start out down here and they're way up real fast, right? That's a little too fast of a move. You don't want to get caught in a potential downturn. But some of them are trending lower, even though they've done well the previous 6 months, maybe the last couple of months, they still got a high relative pricing and good earnings, but they're trending lower, and maybe they've broken below resistance or support, So you don't want that right there. You want it to be breaking out at resistance. Okay? We'll see some of those examples. Okay? So we want the best stocks, but we only want them at the right time. Sometimes the best stocks at the wrong time is just as bad as the wrong stocks at the right time. If that makes sense. Okay. All right. Another key component here is something that I call industry leadership. Okay. So what does that mean? Well, you got a bookstore over here. There used to be a lot more bookstores, and they probably have it over here still, even though it's a university. Right? They have a bestseller section, right? For like, or no, maybe not. I don't know. Not in the university bookstores.
Yeah.
But they, like, if you go to a place like Barnes and Noble or whatever, they still have them around. There's aisles, right? And it's all like that. The front aisle has all the bestsellers. It's the ones everyone wants, right? Because that's when everyone's there. The bestseller shop books. They're not in the back of the store at the bargain bin. Right? So now some nerdy people like you and I will go back there and look at, try to find something cool to read. Okay. But most people go to the bestsellers to see. It's like just like a retail store, they put their hottest fashions up front. They don't put the hottest fashions in the back, because they want people to come in and see what's hot. They want them to buy the bestsellers. Same thing with stocks, okay? The industry's looking for the next big thing, okay? And they're looking for companies that are growing their earnings in the next big thing, because that's where they want to put their money. So what's the next big thing right now in terms of the markets, like in terms of the sector? AI. Who said that? AI. Exactly. It has been for the last, 18, 19, 20 months. So you could probably tell me the top, like 2 or 3 of the top, AI stocks, right?
I'd tell you probably 5. I've been looking at other things.
Yeah. Okay, so what's the top AI stock though? Everyone knows this one.
Maybe the
Exactly, NVIDIA.
GPUs.
Yeah, yeah, and yeah, exactly, you got it, so. And guess what, that's a good stock to own. We're up like 300% in that stock since we bought it, I mean, that's the kind of, and see, if you have, when you buy stocks like that can, with the potential to deliver that kind of gain, it makes up for a lot of big mistakes, a lot of like smaller mistakes, where you lose 10%. Because there's a lot of times you're gonna lose 12%, 10%, whatever. You're gonna make mistakes, and you're gonna pick stocks that you thought were gonna do well, but they just didn't live up to your thing. But then other stocks live up big time. Stocks like Tesla, Google, even Apple now lately, it's been doing good. All those, there's a reason why they're called Magnificent Seven. Okay? It's because everyone wants to get magnificent returns, right? That's how you do it. Okay? So a lot of times people are afraid to buy some of these stocks that are already up a lot, or that a lot of people already own, but that's not a good way to look at it. Are you afraid to like you guys follow football, whatever? Are you afraid to say that the Kansas City Chiefs are a good team just because they happen to have won the last few? No, of course they're a good team. Well, I mean, if you had to bet on whether they'd win it again, it might, it's a pretty good odds. Yes, sir.
So since you're mentioning that, I just wanna ask, in your opinion mostly, so is it better to invest in separate stocks like that, or like a S&P 500 company kind of thing?
Okay, good,
Which
very
one?
good question. Good question. So the question is it better to buy individual stocks?
Yes.
Or like buy like an exchange traded fund or a mutual fund or something like that has all of them? The answer is it's better to have both, okay, if you can. Now, if you can only have one or the other, it's probably better just to have the S&P 500 fund. Because then you have, you got a little bit of money, you got $1,000 or $10,000, but okay, put it in there, right? And that's good to have for like a 401k or an IRA, or you're like, if you have, like an education IRA, or in a pension, you have like like you have university kind of, like the 403B, is that what?
I think so.
Yeah, something like that, yeah. So any of those kind of defined plans where you put in money every month, yeah, you don't wanna be buying and selling like stocks like this, like the way I do it. This is more for your like trading capital, So, but yeah, I have that, like I have the QQQ, I have the SPY, I have the VOO actually from Vanguard, but it's the same components, And the key to those is make sure you just get a good, big, diversified one, like the S&P, or like the Qs, or like a small caps. There's so many good ETFs out there, even for sectors and stuff, specialized and things like that. And they're a good way, it's a good way to do it, Like you can buy an AI-oriented fund that has like all these different AI companies. Okay, but the problem with that is, for every NVIDIA, there's also half a dozen dogs. So you gotta own those too, if you own that bigger fund. That's the downside. The upside is, you get to own all the best stuff, and you get to ride the wave higher, right? So that's a benefit. So I'd say try to do that too, and then, but if you can add other stocks, individual stocks, if you know what you're doing too and you want to put the work in, If you just don't want to think about it, then I would say buy the funds. Okay? But if you want to put in the extra effort and get extra effort results, and remember, money is freedom, right? It doesn't come free though. You got to put the extra effort in, right? You got to use your mind and think about this stuff. And you got to be intrepid too. You buy something, you got your money out there, I mean, it's not for the faint of heart, You got people that you can lose money, there's no doubt about it. People lose money. But people also make a lot more money than that if they're smart. All right, so industry leadership. So AI is a good example. Okay? Cybersecurity is a good example right now. Companies in the cybersecurity space, Palantir, CrowdStrike, companies like that. So that's a good sector. I mean, this year, most sectors have done really well, but some have done better than others. Like energy has not done well this year. Energy stocks have been like one of the bottom performers. So you don't really want to fish in that kind of pond because there's not a lot of big winners in that pond. There's a lot of big winners in cybersecurity, tech, infrastructure, all kinds of different sectors. One of the sectors that's out of you wouldn't think is doing really well, but like energy drinks, like Monster Energy and companies like that. They're killing it, like Celsius, companies like this, like you're like, what? This company's doing it? Like actually, here's a question. Who knows the number one stock in terms of performance from like, I think from 2000 to like 2020, first 20 years of the, do you think like Apple maybe, or Nvidia, whatever? Nvidia is a good guess, it's close. It's Monster Energy. It's up like 30,000% or something crazy like that, right? And so, but you wouldn't really think that, right? But you know why? Because our earnings were like, everybody on the planet is buying those things and they're drinking them like fiends, It's like the drug dealers, trade right there. That stuff will get you hyped up. You guys into that stuff? Like Red Bull and stuff like that? Yeah? Yeah, I know they work, right? But I'm not really into it. I'm like kind of old school. I like coffee. I like coffee. But see, Starbucks had its day. Their stock did really well, and then they didn't.
Yeah.
That's an important thing because at some point Red Bull or Monster will not do as well as other stocks. But you have to kind of recognize that. Your money has to go. There's a saying that we use in Wall Street. It's called, and this is something to write down actually, because you'll never forget this once I tell you this. Money always goes to where it's treated best. Okay. Yes, sir.
I was just thinking, you're saying that with the energy drink and a lot of those industries, money will go somewhere else someday, and it's not going to be as hot all the time.
Mm-hmm.
And that you were mentioning, we should look for hot industries to invest in. But if my strategy is not so aggressive, would it be a good idea to look into like energy you're mentioning, like stocks that are lower and cheaper right now, if I just wanted to invest steadily and long term?
Very good question. You just highlighted two different styles of investing. Okay, so there's this style of investing which is shorter term. Okay, one thing to keep in mind is there's always a time frame element to all these things. Okay? Like our average holding time is like 2 months. We buy it, write it up, sell it. Then we're looking for where our money's going to be treated better next. But when you're looking at a company like, let's say you wanted to go look in the energy space for stocks that are going to pay a good dividend and that are going to keep on performing well over the next 10, 15 years, then you want to look at ExxonMobil, Chevron, BP, these kind of stocks like that. Right now, they're trading at a low multiple. Okay? So and there's nothing wrong with that style of investing at all. It's just a different thing. But what you want to make sure you don't do, okay? You don't want to mix this style with that style. You want your capital for this style here, and you want your capital for that style there. Because when you start mixing them, then you start really making mistakes. You buy something on high earning growth, but then you see like, oh, well, this one has a good PE ratio, and then you start mixing it, and then you start making big mistakes because you're buying it for the wrong reasons.
Yeah.
So just keep those things in a separate kind of, area, and you'll be all right. And like I said, there's tons of ways to be a value investor that are good. Now, traditionally value styles, like the last 10 years, have not done well compared to growth styles. Growth styles have far outpaced value. You guys probably covered some of this already. Yeah. value styles have underperformed because all the money's going to where it's treated best in the growth styles, okay? So, there's nothing, but you sometimes need to have a contrarian mindset too. You say, if everyone doesn't like energy, like one of the newsletters, we do this thing every year, contrarian ideas for the following year. And sometimes we got them right and sometimes we don't. Like last year, China was like a sector that I thought was gonna do well, okay? But they didn't catch up. You know, they did not do well for most of the whole year. Till finally at the very end, they started doing some more reforms in China, and that helped. But yeah, it was down year for China, you know. And same with energy. Okay. I thought energy would do better than it did, but it didn't, you know, because the year before it didn't do well either. So I still have that on my list of potential, like, especially like not just oil companies per se, but like the transport, like pipeline companies and things like that, because I think there's gonna be more drilling, more oil production, more natural gas production in America, but you gotta transmit it. So the transmission stocks, are they gonna be the ones I think that'll do better? That's a little off the topic, but not really, because guess what? Industry leadership. That is what you wanna look at. You wanna look at certain industries that might potentially do well, you know, and then you wanna start looking around. And then you say, okay, well, do they have the earnings growth? Do they have the relative price strength? So it all comes back to all these different metrics that really make the stocks do well. Okay. So finally, just tech stocks, of course, AI and tech. The last few years have been prime examples of industry leadership, because that's where the money's made and that's where the growth was. Keep that in mind. Growth, price performance, industry leadership, and then of course the bullish technical patterns. All right, so this is something that I call News Q. Okay, this is my fifth, and like this is one you've never heard before. Okay, because this is one I made up. So, you guys heard this famous saying? It's called the median is message. Marshall McLuhan, right? But Penn Jillette, the magician, said it's not the median's not the message, it's the message is the message. Okay. The message is the message. What does that really mean, right? Well, it means that the market will tell you what it wants, what it needs, what it's doing, if you listen right. You gotta learn how to listen to it right. And learning how to listen to it is what I call News Q. So you guys know what IQ is, right? Intelligence. Well, you need to develop what I call a news Q, a sense of like knowing what news matters and what is just a bunch of noise. Okay? It's not very easy to do actually. But it's basically, I define it as the ability to take the market's pulse on any specific stock or industry and to see if there's enough positive, okay, or sometimes it's an absence of negative news that can drive a stock higher. Okay. Sometimes you hear something like there's a government contract that didn't go through, or the latest kind of news Q tea leaves are, what will the Trump administration do? You know, what's he gonna do on tariffs? What's he gonna do on energy? What's he gonna do on trade? What's he gonna do on regulation? These kind of things. We don't know yet, no one knows. We have some good ideas on some things, but you don't really know. And you don't really know how the market or the economy's gonna respond to that, you know. Like I remember when Biden took office, everyone thought that clean energy stuff was gonna do great, right? Solar and wind and companies like that. You know, wow, because Biden's pro, you know, clean energy, right? He wants clean energy. Guess what? During his 4 years, that was one of the worst performing sectors. Okay? Conversely, the first Trump administration, everyone like, oh, Trump's pro oil, Trump's pro, you know, drill baby drill and all these kind of things. You think, okay, well, yeah, that makes sense. It's going to earn, you know, oil and energy going to be great. It was the worst performing sector. Okay? And clean energy projects was the best performing sector under Trump. So sometimes what you think might happen doesn't happen. Okay? And if you're watching what's going on, you know you're watching what is actually happening, not what you think might happen. Because there's a lot of different factors for these things. It's not just a surface level thing. So that's what I call developing a high use key. Okay? Knowing kind of what's out there, what matters, what doesn't, what law matters, what doesn't, what personnel matters. Like here's a perfect example. One of the reasons why cryptocurrency has done so well since Trump is he already did this, but he's appointing people to the SEC commissioner and to Treasury Department head. These guys are pro-crypto. These guys think crypto's a positive thing for the country. They think crypto's positive for the thing. Now, the former SEC chairman, this guy named Gary Gensler, he was like the biggest crypto foe in the world. He thought it was a big scam. He was like capriciously putting regulations on the industry, not letting them do X, Y, and Z. Of course, get rid of that guy and you're gonna get more people buying crypto. That's why it's done so well. That's something that anybody can see for themselves what's going on. But people even ask me this, they go, why is crypto doing so well? I just gave you like the names of the people, that reason why it's doing it, and that's what you have to know if you're gonna do this for a living, you need to know the players. You need to know what's going on, you know? And it's fun to know that, you know? I like knowing stuff. You know, you're not gonna be right all the time, but I like knowing stuff. I like knowing that Gary Gensler is not a fan of the crypto community, and Paul Atkins, the incoming SEC chairman, is. You know Paul? I think you do, don't you?
I don't know,
Okay.
I know of him.
Yeah, I know of him. I don't know him either, but he used to be SEC chairman
Oh, I don't
in
know.
George W. Bush administration.
Oh, interesting.
Yeah, so he's got the experience and everything. He's gonna get. But this guy is a Wall Street veteran who explicitly says we need to embrace cryptocurrency. You know, and if that guy's in charge of like the SEC, guess what? There's gonna be pro-favorable. You know, it's gonna be pro-crypto like marketplace. So doesn't mean that crypto is gonna go up, but it certainly sets the groundwork for like one less obstacle. Right?
You know, just a little anecdotal story. I was on one of those Capitol Hill days, you know, back in Washington D.C. We would go around to the various congressmen's offices, and part of the group actually met with Gary Gensler.
Oh, really?
And someone asked him about, you know, regulations, and he goes, you know, he's a Wall Street guy too. He was with Goldman or something like that.
Yeah, he's a Goldman
said,
fan. Everybody's a Goldman fan.
Everyone's a Goldman fan. He said, well, we're the SEC, we have to regulate. So,
he's got a point, sort of, I guess, right? You know, if you're the sheriff, you gotta enforce the law,
Yeah,
I
that's
guess.
right.
But then again, some sheriffs kind of laid back.
Yeah, some are a little
It's not
overzealous.
that big of a crime. Yeah, I mean, but it's kind of a general approach to these things. You know, some people want to take the SEC role and they say, okay, I'm gonna be the top cop, I'm gonna make sure everyone toes the line. Other SEC people are like, hey, we're here to help foster a better economy. We don't want people breaking the rules, but we don't want to stifle innovation. And that's what you want. You want that kind of SEC change. Okay. All right, now here is the element of this service, and here's an element of your investing that is going to be important if you really want to outsize things. So you've got your stocks, you got your bonds, you got your ETFs. You need your more time-oriented, fast-paced, what I call force multipliers. Any military people in here? Anybody in the military? You know what a force multiplier is? You heard that term? Okay. So, what branch are you in?
Army.
Okay, me too. So, in the Army, a force multiplier unit is like a special forces unit. Okay, because we can go in there and train other units from other things, and you increase their effectiveness. Or like in an infantry unit, the sniper is a force multiplier because he can take out key assets and for the rest of the force to go in. So it makes the force stronger. Okay, it multiplies the force of whatever unit you're in. So I use this concept, one, because this is my old job when I was in the Army, and also because A force multiplier is an option, options on the stocks you buy. Have you covered options?
A little bit.
Little bit?
Not too much.
Okay. So who could tell me what an option is? Like a call option or a put option on the stock?
Call options like buy, put options to sell.
Okay.
Options are like you're buying shares of a company, but like at a multiplier, like you said, force multiplier.
Right.
So you buy more shares at a lower price.
Okay, yeah, or you don't even have to own the shares.
True.
Okay, so you're right, for sure. So there's two basic types of options. There's put options and call options. When I'm doing this kind of thing, I only use puts, or only use call options. And I only buy call options, I don't sell call options. Because when you're dealing with options, you can be the seller or you can be the buyer. Or you can be the person that buys the put or sells the put, either way. So we only do what we call slightly out of the money calls, okay? What does that mean? So a call option gives you the right, but not the obligation, to own 100 shares of that stock at a certain strike price, we call it, okay? And for that certain strike price, we pay a premium, okay? And that's the cost of the call option, right? So let's say a stock that you like is trading at $50 a share, okay? But you think it's gonna go up to 55, right? You think it's gonna be a 10% move in the stock, right? And you think it's gonna do that in the next 4 months, let's say. So you take and you look at the options and you say, okay, I'm gonna buy this option that gives me the right to own the shares at $55, because I think it's gonna go up. And I'm gonna pay like $5 or something like that for the price. 5 multiply, you have to do the math on it, it's like 100, it's 100 shares, so $5, so it's like a $500 thing. You're paying $500 for one contract, right? Yeah. So, the $500 allows you to control like 100 shares of the stock, but you don't have to actually exercise that option to own the shares. Okay? All you have to do is hold that contract, and if the stock price starts going up, the $5 you paid for it is going to go to $5, $50, $6, $7, $8, and it goes up about 10 times faster than the actual price of the shares. So let's say you're right, and it goes up, that your stock goes up 10%, goes up to 55, right? You made 10% in the stock. Well, you might make 100% in the calls. So that call might be up, might have moved up to like $10 a share for your price point. So, but on the underlying stock, you only made a 10% gain. But in the call options, you might make 100% gain. That's the difference. And because what you're doing is you're taking advantage of the leverage and the time constraint. So people want to own the shares at 55, so they're going to buy that contract from you because they think it's going to go to 60. So they might actually exercise it at 55, and then the stock's at 60, but they can still buy it at 55. Right? So that's about all. We're not going to get much more into that right now, but the point is, like, if you know how to buy the right call options at the right time with the right stocks, you can get big gains. Like, not just like a 10% gain, but like a 400% gain. And in 2 months. That's the force multiplier element. Because you're using, and also too, the good thing about like a call option is you buy one contract $500.
I have a question. Why do you only buy call options and not put options at all?
Because the put options mean I think it's gonna go lower.
Okay.
And I'm only looking for the stocks that I want to go higher. Okay. So now if I was looking for stocks that I thought were gonna go lower, then I would buy the puts. And in my other option service, we do that too. Because we think there's some stocks that we don't like. We think we're looking at different metrics than what we were just talking about today. But this goes back to the other, like a lot of different ways. You know, there's the value investing way, there's the short way, there's this way. Just have to make sure your baskets are not commingling, you know. So, okay, so if we're correct about the direction and we buy them at the right time, there's like a new uptrend, out in money calls will rise dramatically. Okay, so here's what I mean by that, right? This is what I call the Hall of Fame, HOF, best wins. I've actually had some better ones than this, recently, but this will give you a good sense of like some of the companies and some of the call options and the returns that you can get if you're employing the right techniques. Okay, so like what's an average gain like per year? Like in average like Wall Street gain basically, average S&P return, right? Like 15, like 12% a year.
I think, about 15%.
15%, right? That's a good, like, 15% annual returns. If you can get that year in and year out, you're good, right?
You're good.
Okay. What if you can get 447% in 41 days? Might be a force multiplier, right? Okay, now, am I gonna get that every time? Of course not. Okay. But it's definitely doable if you get it right. Okay, so, some of these companies, you guys probably know some of these companies, right? So, Tractor Supply, this company, Tractor Supply, is kind of like a, not Home Depot, but it's like a pet store, but they have like feed. You been to that store before? Yeah. Yeah, so like I live in a rural area where I have like horses, right? And so I go there all the time, feed, and I spend a lot of money in that place every month, so I knew like, hey, this stock, maybe there's something like on this stock.
You're
So then
making the stock go up.
I know, exactly. I was like, I was making the earnings per share grow. So, but it's true though. That's one way to do it. Like if you go, like some people go to Costco and they go, oh, I got a good deal on this and that. I go to Costco and go, let me check their earnings out, right? There's a lot of people in this place, right? And sure enough, that's been one of the best stocks to own, Costco, because people love it. They make their margins, they grow their earnings. People buy the stock, they have good chart pattern, own it, You should own what you find in the world. Like, who has iPhones? Who has an iPhone here? How come we don't have Apple stock? Think of it like that, Something that everybody has, almost everybody. They make a lot of money off that thing, right? Thing's expensive. I just upgraded mine. It was like $1,200 or whatever. That's a lot of money for a phone, But guess what? I use it every day. Like, I couldn't live without it. Okay, so Thor Industries. Who knows what that is? Let me show you. I'll tell you a story about it in a minute because we're going to look at charts of these things. I'll tell you why I bought it. I'll save that one for next. But Match Group, okay? Match Group. You guys know, if you're single, you might know what this is. Match.com, right? Tinder, Grindr, all these different apps, right? That's Match.com. Make a lot of money. A lot of people looking for mates. They'll pay for that. Vista Outdoor. Okay? A lot of gun enthusiasts out there. A lot of people. What do they make? They make ammo. Ammunition. Taiwan Semi, we all know what they do. Everybody's computer at home probably has a chip in semi. The one I'm using right now, Taiwan Semi. Okay, so these are not small names; they're well-known names, and we got this is the kind of, if you buy them at the right time, this is the kind of stock returns you can get, like 45.75% in 63 days, right? It's pretty damn good. Tractor Supply was 20% in 56 days. Match Group, 38% in 41 days. Vista, 44.69, 70 days. Okay. It's Taiwan Semi, 55.45 in 120 days, 119 days. Okay. So these are all really good wins. These are what I call the Hall of Fame wins. But these are the call options that also bought at the same time as we bought these. Okay. The Thor September 70s. So this was a 45% gain in 63 days, but guess what? This was a 301% gain in 63 days. Okay, that's because that premium price skyrocketed as the stock went up. Okay, because people were like, "Hey, we got to own this thing. We're willing to pay a premium on it." Same with Tractor Supply here, 151% in that same 56 days. Match Group, 447. That's like one of my best calls ever. 41 days, okay? That's real gain, that's real returns, okay? How did I know that was gonna happen? Of course not. But I looked at all the metrics and thought that this could be a good breakout time for match, and it was. Okay. Now Vista, 220% in 70 days, and then Tractor Supply, Taiwan 70, 243 in the same 70 days. So buy the stock, buy the out of the money calls. Get the force multiplier effect. Now some people say well, why don't you just buy the calls? It's less money, you know, it's less outlay, and if you're right, okay, that's great, you can do that. Sometimes I do just do that. But you also run the risk of of a big loss when you do that too, because these are volatile. Anything that goes up 300% in 63 days can go to 0 in 63 days, easy. Whereas this stock is not gonna go to 0. It may go down 10%, but it's not going to 0. You can get out of it a lot easier. But with the other one, you might lose everything. Okay. That's what happened. Yes, sir.
Is that why you decided to sell the match one after 41 days? Because I noticed that was the shortest period of time, even though it was the greatest.
Exactly. Yeah. Well, and another reason we decided to do that is when you have that kind of gain in such a short period of time, you get diminishing returns. Because it's not going to go up another 400% in the next 20 days. You hit a home run, and now you're going to try to go back up again and hit another home run. It's kind of hard.
Yeah.
Most likely you strike out. So take that home run, take your money, go in the dugout. Okay. You want to be smart about it, right? You don't want to tempt fate, because look, you already got you got it right, man. Take your money and then go to where it's traded best, because it already treated you really well here. Now you got to find new ones. These aren't going to continue to treat you like this.
One of my favorite Wall Street maxims is the pigs get flat, the pigs get fat and the hogs get slaughtered.
That's right. Pigs get fat, hogs get slaughtered. Yeah, that's one of the best ones. Yeah, because we're being piggish right here. We want these big fat returns, but if I let it ride, I lose it all. You don't want to lose it all. And one of the worst things in the world, which happened to me all the time, until I started learning my lesson a little bit better. I would get this 400% in 40 days, and I'd be like, oh man, 1,000%, we're gonna go, and then next thing you know, it's like, oh, it's only down 300, it's only up 300, and then pretty soon I sold it for like a 20% gain. Like, okay, that 20% gain's good still, right?
Yeah.
Not when you already had 447, right? It's not good. So, don't be a pig. No, be a pig, don't be a hog. Yeah, there you go. Okay, so here, I mentioned Thor Industries, so so these are the dates on these things. I try to pick some representative ones from different time periods, but May the 7th, 2020, okay. It was just a little over 4 years ago, right? But it was a whole different world, right? May of 2020, what was that? What was that?
After COVID.
That was peak COVID, right? That was peak lockdown, right? Okay. Everyone thought the world's going to hell. We're gonna die. Everybody was like pretty worried about it. Obviously, means legit worries, of course. A little bit too much of a worry, but still like legit, right? So this is the price chart of Thor during that time, right? This is May of 2020. So something interesting happened in March of 2020. And it caused almost every stock in the market to go from this to this. Not all of them went up there, but went from this huge COVID shutdown plunge to the big COVID, this pre-COVID buy, this mid-COVID buy. And whoever gets this one right, and don't answer it, right?
No.
You already didn't know it the first time I did it.
I've heard this
You've
before.
heard this one before. What do you think happened here? What's the news cue point that happened here that allowed people to get back in the market? No? Yes, sir.
Stimulus check?
Very close. You're very much on the right track. You almost got it. Wasn't the stimulus checks. I came much later here. Later part.
Unemployment checks?
No,
Something like that?
no. But you're close.
No,
Huh?
PPP loans.
PPP loans, no, that came later too. That was way down there. It's something that was, that a group of policymakers did one day.
Oh, the interest rate?
Interest
Yeah,
rates. See, I give this guy a name right now. Interest rates. The Fed stepped in big time, slashed rates, opened the bank loan window, injected capital into the system. And then the markets love that, right? We love cheap money because we can leverage it. And that's exactly what we did. Remember, money goes to where it's treated best. So the Fed opened the doors, boom. We treated it just like we wanted to. You know, we bought. And we didn't stop until 2022. That's the kind of awareness you need to have, you know. I mean, it wasn't a big secret. Everyone knew that the Fed did that. And that's the reason why almost every chart you look at from this period, do a post-analysis of charts from this early, you know, the first half of 2020, and you'll see this exact same pattern on even the worst stocks. Very good. What's your name?
Abraham.
Abraham. Good, very good. Okay. So, Thor Industries. Remember I told you what no one knows what it is, right? Okay. So, the stock started going higher right after the stimulus, right? So people were able to get loans, Fed interest rates. But they had all this, a lot of people had money, but they were at home. They were stuck. Couldn't do anything, couldn't go on a plane, couldn't go to a hotel, couldn't go to an amusement park, couldn't go on a cruise. But what could you do? Okay? Yes, sir.
Go on vacation.
Go on vacation, but how could you go on vacation?
Road trips. So they're an RV company, correct? Right?
Very good. Road trip in your RV. You can be in your own RV and road trip and go see your relatives and go cruise around the world and cruise around the country. And guess what? No traffic. It was the best time ever to have an RV and be cruising around and stuff. And gas prices were super low too. Okay? It was the ultimate. You can cruise around and go to these national parks and stuff like that and do it, see the country. And that's exactly what people did. So they flooded right here, they flooded in. And guess what? The earnings growth for Thor was crazy, really high, right? Boom, stock went all the way up here like this. 300% in the calls, or in 2 months. You know, from May all the way to early July, and then we sold it right around here when it started to break down a little bit. Went back up a little, but then it broke down. So we saw this technical pattern, and you mentioned this before on breakouts and on resistance. Okay, the red line is what's called the 200-day moving average, and the blue line is the 50-day moving average. These are shorter term trend lines. Okay, a lot of times this is where resistance is. So when the stock broke up through the 50-day average here in late April, and then again in the 200-day average in very late April, well, they're both basically in late April. And then we started getting the earnings reports from Thorben showing that people are flooding the place. Then we knew to buy it around here. Okay, that's the breakout that we bought. That's a perfect example of knowing the situation, like knowing the news queue, knowing the earnings growth, knowing the share price performance, knowing the technical pattern. So I always like to use this one because it's a perfect example of the news queue element. Okay. All right, Taiwan Semi. This one was less news queue oriented, but it was at the same time because in late September of 2020, we all were settling into the fact that we're going to be working from home for a long time. We're going to go to school from home, you're going to work from home. What do you need when you need to work from home? A new laptop, okay? Who makes the insides of a new laptop? Taiwan Semiconductor. So of course you're gonna have great earnings per share growth, right around here, okay? September is when they started to have like the good, strong earnings growth. And guess what? It fueled the stock run from here all the way up to here. Finally, we got out of it. Got out of it before the peak, but that's okay, because pigs get fat and hogs get slaughtered. And we did it with a big number. See, this shows you that a stock can go up, even a stock as big as Taiwan Semi can go up almost 60% in just a few months. Okay. Stocks can do that, but they have to have the earnings growth. They have to have something fueling it. Okay. In this case, it was the pandemic, PC upgrades. Okay. All right. Cruise line, Royal Caribbean. I'm not a big cruise guy. I've only been on one cruise, and it was a super nice cruise, like super high-end luxury cruise. And the only reason I went on it is because I got paid to do something like I'm doing right now. Okay. And that's something important to keep in mind. Like if you have some skill that you can use, people will pay you for it, and they'll pay you for it to do. They'll say, hey, come on, do this, and share with us your knowledge. I've done a lot of fun stuff like that. We've done fun stuff like that together.
Yeah.
We've been to New Orleans together and the Bayou, and we've done all kinds of fun stuff together.
Freedom Festival.
Guess what? That's because people want us to they're paying us to give us information, right? Yeah, exactly. So that's a good thing to keep in mind in the world. Have a skill that people want to find out about, and they'll find out about it. They'll pay you for it. It's fun. So now this is in May of 23, right? So we pretty much, got through the pandemic stuff. We got like the world started getting back to normal, like right around this time. But still not a lot of people were doing cruises because it was still like lockdowns, still shut down, things like that. But by this time, people wanted to get the hell out. They wanted to have fun. So then like this is what they call a double bottom. Remember I was talking about the technical patterns that I like? So the stock actually sold off really, really aggressively in March of 23, and then again in April. It hit this bottom level here, and then it hit a little bit lower than that bottom. So it was a double bottom. Put in two bottoms right there. And generally that's a point when the smart money says, okay, there's been enough selling in here. Let's check it out. So guess what? In later May, after the stock came back up above this resistance level, okay, at the 50-day average, it started spiking up again, and it had some good earnings growth. Okay, because they said, oh look, people are booking forward advance, booking cruises for the latter half of 23 and 24. Okay, so the stock jumped right back up, and in like just a few days, boom, did really well. So we took that profit and almost 100% gain in the calls because we didn't want to be greedy again. But we should have, in retrospect, kept on owning it until July at least. You missed out on this, but that's what you got to realize, that you're never going to know exactly when to buy and exactly when to sell. The key is to get the majority of these big moves. And if you get out before it, you don't regret it. Okay? It just happens. Not gonna, because the only person that knows where the stock is gonna be like this from here doesn't exist on the planet. You gotta have deity level like prognostication. None of us have that. Okay. The big bad boy on the AI block, NVIDIA. And we own that too. I still own it in a couple different portfolios. But this goes to this will show you like why you want to dip into some stocks at certain times and then dip out of them at certain times when you make a big run higher. So November 23 to February of 24. Okay, so November right here, mid-November. See where it broke through this blue line right here? This is where we bought it right here. And we had a double bottom. Bottom, bottom, boom. Okay, that's the technical pattern that's bullish. So a lot of people got shaken out, but then they came out with good earnings, and once they crossed this line right here, we got in. Okay, and then we rode it up here like this, and then started to give back. Like, oh no, we made a mistake, you know. But we were still up in it. But see, then it came back to the technical analysis part, where it bounced back off this support at the 50-day, and then kept on moving higher. We kept on owning it, and then we finally owned it till about right here, when it really had made a really nice move from here all the way to here, which was almost 50% in the few months that we owned it. And of course it kept on coming back up, and then it came back down, but we were already out of it from here. Now it's like over here, now it's like way up here, you know. I mean, so along the way we purchased it again and sold it again and stuff like that. But I mean, if you had it used to be down here, right? And now it's like up there. So if you're a longer term investor in this, okay, then yeah, you can, you know, all more power to you. That's a good way to be. But you don't know that. That's the problem. You don't know that when you buy something here and you just keep on holding it, it's going to be up here. Most of the time you buy something here, it's just going to continue to kind of give you mediocre returns. But you don't want mediocre returns. There's too many good companies that are giving big returns, and that's what you want to be in. That's you want to be nimble, okay? You want to bet on the winning horses, the ones that are like they have the best chance at any given moment to do really well. Okay, you guys been to this restaurant, Kava?
Yeah.
It's good, huh? Yeah. See, it's always busy and it's a good product, right? Okay, tastes pretty good. I've only been there a few times, but I own the stock. Because I know people love it. And how do I know it? Because I look at the earnings per share growth. And I know that they're making a lot of money. And I know Wall Street loves it because I'm looking at the price action. Relative price strength is really strong, right? So this happened to be earlier this year, okay? May 24th. And in fact, the last time I spoke to your CBU class, we had just bought this and we ran it up. See, but only owned it for like 4 weeks here, you know, just for the month of May. Okay, the reason why is because we went from early May all the way to the end of May, and then it pulled back out. Here's another thing too, like I didn't mention this, but when you buy stocks, you always put a protection on it, a stop loss. You guys cover stop losses and stuff? No, okay. So when you buy a stock, you want to go in there knowing how much you're gonna lose. Never want to lose more than you set, the preset amount that you say that you, and it's easy to put a stop loss in. You go on your account, put your number of shares, how much, you know, where you know, market order they call it, and then you put a stop loss in at the same time. So if the stock is $50, you don't want that thing to go down to 20. Then you just lost a lot of money. You only want it to go down, like, I don't know, it depends on your tolerance. I like about 12%. So if it's a $50 stock, I maybe put it at like 42, maybe 43, something like that. It's about as much as I want to lose. Okay? Because sometimes you just buy something and the next day it goes down past and you buy you're out. Okay, but that's okay because you're willing to lose that much for the chance of more upside. But if you buy a stock and then you just go, well, I'm just gonna see what happens, you know, and then it goes down to 40, and then you go, oh well, I really like this stock, I'm gonna buy some more. Then it goes down to 30. Now you're like double in the stock at a way higher price and it's still lower, and now you're pissed because you should have just bit the bullet and had a small loss. Instead, you have way less money and you still own the shares. Now you don't want to sell it because now you're like, well, I can't sell it now. I can't take that loss, right? This is especially true if you're dealing with like larger numbers, like you buy something for like $500,000 whatever, in one stock, right? And then it goes down, and you're down like 2 days, like a week later, you're down. You only got 400,000 in this. You're like, oh my God, what am I doing? I got to buy some more, and then you're down again. Now you just lost 200,000 in a matter of like weeks, and you're pissed. No, that would definitely ruin your day. So you don't want to do that. You'd rather just lose a few. You know, I'd rather lose 70,000 in a position, and then rotate it into something else that I think is going to do better, because I made a mistake, didn't work out for me. All my thinking might have been right, but guess what? It's reality. It doesn't always conform to your thinking. I wish it did, but it doesn't. So all the good plans, that's one thing that's cool about the markets, is you can have all the right ideas and you still can be wrong, and you can have bad ideas and still be right. Every once in a while, people are right that they just don't really think it through, but they're right. And then sometimes you think it through and you're wrong. Guess what? It's called life. So, you make the best play. But if you're really thinking things through and you're disciplined and you have your stop losses and stuff like that, you definitely will see results. May not be maybe like this kind of results, or better or worse, but you're definitely not going to be. You're not going to lose a bunch of money at a lot. Okay, you might have small losses, but you have some big wins too. Okay, that's how it works. Okay, so this was a slide of actual closed positions that we did. So remember I told you you're not always going to be right, you're going to be wrong sometimes. Okay, so here, some of the companies we owned like from in February all the way till July. I need to update this, but this will serve purpose. Be fine just for the purpose of it. So these were the buy dates, so February to late February. And this one we really did well, 34%. And this is the common shares. But then, okay, we got this one wrong. Remember I said a 12% stop loss? Okay, I got stopped out of that one pretty quick, in a couple of months. Synopsis is software. And then here's another one. 14.97%, we got stopped out of this RX site company. Okay? And then there's another one, 11% loss, 12.8% loss. Like, okay, right here you get 3 in a row like that, you're like, okay, that's no good, maybe I'm doing something wrong. But no, because look at all these other ones. Like, what is it? 4 losses out of like a 12 or whatever it is. That's a good ratio. That's a really good ratio. Here's those same trades with the options. Not all of them are exactly the same, but these are closed option positions. So remember when I told you like sometimes the options are really volatile, you don't just want to buy them sometimes because otherwise you can lose some big money. Okay, look at what we did here. We lost 80% in the Zoom March calls. Okay, that's a big loss. Your $1,000 that you bought right there, now it's $200. Like, ugh, that's no good, right? But look at the other ones. Your $1,000 now, $2,000 or $3,000 rather. Now it's more than that's like $2,200. That one's $2,300. So these are some big triple digit wins. See, this is the power of good leveraged call options. These gains of like 130, 170, 128 in like 21 days, 91 days, 29 days. And then there's that Cabo one that we just talked about, 316%. Then we had the 60% loss or 69% loss. So the point here is you're going to be wrong, and you're going to lose on the options. You're going to lose more in any individual option, but you're also going to make a lot more on the individual option. Okay, so here's the last one. This is the one that you want to take a picture of if you have any kind of like desire for that. So this is the main. This is basically how I do this in a nutshell. Okay, so I screen for the high relative price strength. By the way, this is on the test, right?
Yeah. On that little scan drive.
Yeah, there you go. Yeah, there you go. There's this. Name the five characteristics. So, relative price strength, screen for the earnings growth. Buy on the bullish patterns, the cup with handle, the double bottom, the flat base. Buy on the bullish news cue. Okay, Thor story there. Buy the slightly out of the money call options that we talked about. Hold, this is very important, hold until the momentum ceases. Okay? You're right about something, you buy it, it starts to move up, it starts to slow down. That's why a lot of those times when when we sold the stock before, when it was kind of just slowing down a little bit, we got out because we made our money. And then kept on going a little bit higher, but that's okay. The momentum slowed. Because you don't know when it's gonna start slow and then really turn down south. You just don't know, you don't wanna give up a big game. Set those stop losses, just mentioned that approximately 12%. Average days held, this is important. Average days, in all the positions over the years. We've been doing this like as an official service since 2018. And so we've had 54 days as the average. That's pretty tight, that's only 2 months. And one thing about that is, people sometimes say like, when you're investing, you wanna reduce the volatility, right? You wanna keep the volatility in portfolios lower. One way to do that is to not be in any one thing for a long time. Because the more you're in something, the more you have a tendency to stick with that, even if things aren't going well. If you know you're gonna be out of there if things start to go south, then you already have like lowered your volatility in your portfolio. Because you're not sitting there owning something that's going left or right. If it's going down, you get out. If it's going up, let it go up and then you get out. Average annual return, okay, this is important, this is a super important part. You guys know what average annual returns are. So that, we talked about that 15% for the S&P, right?
That's basically 15%.
Yeah, this is 86.25%, okay? So here's what that means in real money. If you started it with $100,000, the next year you have $186,250. That same 100,000 in 4.5 years, which is how long this has been doing, the same 100,000 is 1.6 million. There's your freedom right there. That's what you're doing this for. And that's this kind of investing or any other investing. Okay? You're doing it to turn the 100,000 into 1.6. You're doing it to make what you have now into something very special. And you can do this, it's open to anybody. That's the thing that's cool about like investing like this, or like any investing really. Which is good, this is the kind of thing that you study, this is the kind of thing that we do with helping people do this, because, and it's one reason why we like it so much, right? It's because you're not just showing like ratios on a chart, like an economist does that. It's not a real world thing. It is, but I mean, nothing against economists, but economists aren't gonna put money in your account, but this kind of stuff will. What you learn from us is gonna do that, if you're smart and if you take this seriously and if you decide. So one thing you gotta do, before you even, think about this over the weekend or whenever you get an opportunity. Every day that goes by that you're not investing money, it's a day you'll never get back. That's time, it's money, that's an opportunity that you just wasted. You only have a certain amount of days in the world. Don't mess up. Make good decisions. Any other questions?
So I can only ask one question. I'm going to whisper to the. I told him last class we shouldn't ask this question.
Okay.
I'm curious.
Yeah.
What kind of car do you drive?
You always do this for me, I just have a regular car. He wants me to say that I have a Bentley, which I do. Everybody wants a ride in, we can go home right now.
So that's what this will get you.
Yeah, there
is
you
a
go.
Bentley.
But actually, here's the thing. Like I'm into cars, I'm into fun, cool stuff like that, right? But it's not so much the actual thing that's cool to have. It's the ability to do what you want. Because some people wouldn't want that car. They want to start up a charity or something like that, or they want to, buy a second home or they wanna, help their family out, and take care of all the relatives. Whatever it is you want, you can do it, but you have to have the capital for it, So that's the important thing, I think, at least. That's why this is important, Yes, sir.
Is that a royal oak on your wrist?
No, it's not. It looks like that.
It looks like
Yeah, very good. You're into watches too.
A little bit.
Cool. Yeah, me too. I spend way too much money on watches. I'll show it to you later. That's cool. It's a similar type. Yes, sir.
Do you mentor people? You have people that you mentor?
Oh, that I mentor? Through the newsletters, yeah. Not really individually, I don't, per se, and I don't manage money. I used to do that. I don't do that any longer. Because in the newsletter business, we're all about advice. And we're all about advice that is not personally directed at one person. We have reasons for that. We have SEC rules and FINRA rules and stuff. So if I tell you buy this stock and I tell my subscribers buy this stock, whatever, they're gonna go, oh, you're giving personal advice. You're not allowed to do that. You're not a financial advisor. You're not You're not registered with with the SEC. Because I used to have all that when I worked at Morgan Stanley. So then I had a fiduciary responsibility to not. Some of the stuff that I do now, I can't even do that if I'm running some of these newsletters or some of these banks, because they don't want you to do that. They want you to put the money in and leave it there and buy and hold, and they don't want you trading like this.
You're gonna be too smart for them.
Well, I don't know about that, but it's the differences in incentives. My incentive with this is to make as much money as possible for subscribers, right? I want you to be able to get as much as you can, right? But with money management firms like Morgan and Schwab and stuff like that, if they're doing their asset management, they get paid by the amount of assets you hold in the account. So if you sell something, they don't want that. They want you to. They're like, okay, just bring it here, keep on giving us money. And they charge you 2%. But if you sell and you're out of there, they're like, oh, we don't want that. You would think that there would be an incentive for them to grow the capital at that level, but they don't.
How does one subscribe to your newsletter?
What's that?
How does one subscribe to your newsletter?
Oh, very good. Thank you for asking that. JimWoodsInvesting.com. Go there and if you give me your details, I'll get you a deal. If you're interested in that, get you a trial, a few months, check it out.
So guys, we have probably time for about one more question,
Okay.
if anyone has any more.
Yes, sir.
Are there any stocks that you have that you will never sell?
Very good question. Yes, there are.
Can I ask what?
Yeah, I'd be happy to tell you. I have in one of my newsletters, we have this thing called the income multipliers. And it's 20 stocks that I think are good to own for the long term. So some of them are, we have mentioned some of them already tonight. ExxonMobil, Walmart, Lowe's, Cummins Engine, Caterpillar, UNP, the railroad company, Albemarle, the lithium company, which has not done well the last couple of years, but previous years it did. Now, why am I picking these different sectors, right? I usually got two from each different major sector, a consumer discretionary, an energy, a computer or consumer staples like P&G and J&J, stuff like that. You want to have a good basket of diversified stuff like that, because that helps generate income for your account. It helps that's the traditional income investing, dividend paying stocks that you want to buy, keep on buying and holding them for your kids. Don't ever sell them. Mm-hmm. That's a good, you want that, This is different than that, obviously, but I recommend that. You need to have something in there, gives your overall portfolio ballast. And if you can, if you're at a stage where you have a lot of money, and you don't even need the growth like this, let's say you got like $10 million and you're retired, you're 60 years old. You don't need to be doing this, you know, it's too risky. Buy something with a good yield, good dividend return, and you're living it up. You know, that's the kind of thing you want. But it's different stages in life, you know. If you're in a stage where you want to grow the money, which most people are, and not just like age-wise. Most people need to keep growing their portfolio because they don't have like $20 million laying around, you know, or 10 or whatever. Most people, they got like, maybe if you got $1 million, you want to turn that $1 million into like 11 million. Well, you got to be aggressive. You can't just buy like the dividend stocks and say, well, yeah, that'll get me to, you know, a second home in like, you know, Aspen. No, it won't.
Yeah.
You know, you got to be more aggressive.
Yeah. Thank you.
All right, guys. Oh, yes, sir, one more.
So you talked about a lot about long-term investing, right? I need to know your thoughts on the S&P 500 specifically, because I don't think you ever brought it up. Well, I was gone for a bit, right? I don't think you ever brought it up though. So
What do you mean? What do you mean by S&P?
Do you?
We talk more
should you
about
buy
shorter
it?
term investing.
Should you buy it? You know, it's like, at what point in my life should I buy the S&P 500, or you know, at least tap into the?
Yesterday would have been the best day for you to buy it.
Okay, that's right. Well, any day, you know, in the future, I'd say. Right?
Okay, well, here's the thing. If you don't have exposure to the equity markets now, then you're only hurting yourself. Now, you could say to yourself, S&P just crossed 6,000, I'm waiting for a pullback, you know, the market's been up the last couple of years, there's a lot of headwinds on the, you know, on the horizon, there's like, what, you know, it's getting a little overvalued. You can make all those arguments. People made those arguments when it was at $1,000 or 1,002. So that's the problem. There's always the trepidation that people have for you can convince yourself to not do something in the market easily, but you'll only hurt yourself by that. The person that is like waiting. Okay, here's a perfect example. 2008, the market crashed, right? Very bad year for markets. Didn't get, you know, global financial crisis, banks all messed up, you know, all that whole like, you know, meltdown with mortgage industry and also the housing markets. 2009, market started coming back, and it has basically not stopped since. You know, there's been some pullback years, like 21, but it hasn't stopped since. You know, there's still a lot of people just sitting there waiting to get back in because they didn't. They're like, oh, I don't know, I want another 2008. A lot of people that I've spoken with over the last 5-6 years are like, hey, don't you think there's going to be a big pullback and pullback? I say maybe, but what about the meantime? I mean, there definitely could be a pullback. We could go back down to 5,000, like fast. Because usually what happens, here's another Wall Street saying, markets take the stairs up and the elevator down.
Mm-hmm.
Okay. But guess what? The elevator stops, now it's time to get back. So if you were the kind of person who wanted to wait for the next big pullback, that's okay to do, but you better get back in when that pullback's over. Otherwise, you're gonna be the rest of your life, I'm waiting for a pullback. And that's what you don't want to be. That's missed opportunity. That's not good.
So basically, just don't hold on to your money.
Yeah.
With that, guys, this has been some really, really great and valuable advice that Jim's given us tonight, and we want to thank you so much for.
Appreciate it. Good luck. I'm glad you guys are.